The four most dangerous words in investing. This time is different. Those are the words of Sir John Templeton, and much like the laws of physics, the market and the economy, you know, never really changes. The patterns that you see now have occurred time and time and time again, and they never change. History has a massive tendency to sort of repeat itself in all spheres, whether that's politically, economically, or socially. And this is sort of encapsulated by the phrase "history doesn't repeat itself, but it often rhymes." This sort of goes that although some things may change, most time it sort of rhymes, and it's the patterns repeating themselves over and over again. And this is because of our human psychology that never really changes, and this means that events, behaviors, and patterns tend to occur over and over again. What drives us, what motivates us, deep down, this has not really changed from the Roman times or before that, and that's why everything you see has repeated before and will continue to repeat in the future. The basic motivations and what drives us haven't changed, and those underpin sort of social structures, economic cycles, and the sort of nature of the system, and that's why it's not different this time at all. As explained, the sort of reason for this is down to basic human psychology. People are influenced by their emotions, their biases, their perceptions, which have remained constant throughout history. Whether that's fear, greed, ambition, desire for power or control. These are sort of the inherent human emotions that drive us and lead to the same outcomes over and over again. For instance, economic bubbles, they've occurred throughout histories. One of the great examples is sort of the tulip mania during the Dutch Empire, like the 17th century, where the prices of tulips went to sort of extraordinary levels, only to crash dramatically. And then you've obviously seen the same maybe in the .com era, where internet stocks went to crazy levels. You had, billion-dollar evaluations for companies that really weren't worth anything. I think there was an example called InfoSpace, which at its peak had a market cap, I think, 30 billion, with shares at 1,300, only for it to collapse to $2 a share. And there was another company during the .com era called Gadzoo, which tripled, I think, on the first day of trading, got to a market cap of 2 billion, and later on it was sold for 5 million. And these extraordinary skyrocketing valuations and bubbles and collapses have been seen time and time again. 2008 was another example of this, where you had a pattern of easy credit speculation on housing, which led to a bubble, and then eventually the bubble burst and it triggered a massive financial meltdown. But if you start to understand that these speculative patterns occur over time, and you understand it now, then you can start to prepare yourself for next time. You can start to look out of these patterns and spot these patterns, and then you'll be able to make intelligent decisions based off that. And human psychology, it underpins more than just these boom bust cycles. It underpins, society and power dynamics. Ray Dalio talks about it in his book, which I highly recommend. This is The Changing World Order: Why Nations Succeed and Fail. And this talks about all the empires that have come and gone, sort of the Dutch Empire, and it explains in detail with data, what makes empires rise, fall, the dynamics behind that, the debt cycles, the power cycles, and how you have a prosperous nation that creates wealth, eventually leads to huge wealth, which causes wealth gaps. Then it follows by inequality, which causes social unrest, much as what we could see in society today. And that pattern of unrest, social unrest, continues so long as the underlying issue remains. And when you have social unrest, you have new rising powers and dynamics, which repeats the cycle over and over again. But yeah, I highly recommend this book if you've not read it before. It's an incredible book, definitely in my top 10 books of all time. Ray Dalio also has some videos where he explains it in about 30 minutes, sort of the rise and fall of nations and why empires fall and collapse and rise. But yeah, this book sort of goes into all about human psychology and about how the debt cycle interacts, economic cycles, the expansion, the downturns, inflation, recessions, crises, speculation, and all these patterns who have occurred. It starts with the Dutch Empire, then the British Empire, then the American Empire, also some of the sort of Chinese dynasties, how they all rise for the exact same reason. They all exhibit the same patterns, and they all fall and collapse for the exact same reasons. And it's going to give you the ability to sort of recognize these patterns that have occurred throughout history, and use history as a way to learn from these patterns, and that's going to give you guidance for the future. Now, within these large debt cycles that Ray Dalio talks about, you have several smaller patterns that you should pay attention to. So the obvious one is sort of bull and bear markets. These are perhaps the most fundamental pattern to recognize, and these are patterns where you have a rise in, which is the bull market, and a decline in market prices, which is the bear market. So bull markets are sort of characterized by massive investor optimism, economic growth, economic strength, confidence, rising stock prices, and bear markets are obviously the opposite of this. They're when everyone's pessimistic, there's economic slowdown, recession, stocks are falling, and these cycles can last, months or years. And often what occurs is when you have a bull market, you get eventually it leads to exuberant behavior, because when prices have gone up for, let's say 5 or 6 years, everyone's overconfident. Everyone thinks this trend's going to continue because it's, occurred the previous year, it went up. People see the past, they think, right, it's going to go up next year. And eventually people get more risky. And what it leads to, and it's shown throughout history, is market bubbles, when sort of these asset prices get significantly exceed their intrinsic value. The dot-com era was a perfect example of this. But you obviously go back further to sort of the tulips in the Dutch Empire and the housing. Obviously, you had 2021 going into 2022 in the stock market recently, which was sort of a peak bubble where you had all this excess money and speculation. You look at cryptocurrencies, everyone was speculating because there was loads of money, and eventually, the intelligent investor in those situations would realize that it was a bubble and come out. Otherwise, you will get the inevitable, which is the crash. And this always occurs. The up prices always crash after dramatic rises. They always correct themselves. And, you've seen this with, you had the 2021 crash, obviously the dot-com crash, the housing bubble, all these massive bubbles eventually burst and they come crashing down. And unless you want to get caught up in the crash, you need to recognize when a bubble is occurring, and then you can get out and make the most of these crashes, because during these crashes is when all the money's made. This is because, if you're in the crash, the price could be 75% off. You've seen this with Meta recently. The price got 75% off. If you're an intelligent investor, you go, right, Meta's a good business, put your money in. It's going to return to its normal level, to its intrinsic value. And that's exactly what it did. And if you make the most of these crashes, you're going to get great businesses for a discount. That's sort of Warren Buffett's principle, is to get great businesses, at a discounted price. And, in those moments, you've got to remember, be fearful when others are greedy, and greedy when others are fearful. And when the market's fearful, that's your moment to buy great businesses, invest in great businesses. And that's going to make, if you understand that pattern, that dynamic, then you're going to do extremely well coming out of this. You've seen Meta return to where it was. So that's already, a 400% return. If you got in, when everyone was fearful and everyone thought, Meta was dead. And if you were, intelligent and strategic, you would have realized that Meta is a phenomenal business, and you would have made a 400% return on that investment. Now, as the economy sort of goes through generic troughs and peaks, it's important to note that investors tend to shift to different sectors. This is because different market and economic conditions favor different sectors more than others. So sort of during a bull market, consumer goods, growth stocks are going to tend to outperform other sectors. You saw this in sort of the 2020 to 2022 bull market, where e-commerce did incredibly well. people had loads of excess savings, money was flying around, and that meant people were spending, people were buying consumer goods, and e-commerce and did extremely well. So stocks like Shopify and Amazon did incredibly well. But during when prices are declining, it's more the defensive sectors like utilities, healthcare that tend to do better during a down market. This is because people continue to rely on them regardless of the economic situation they're faced with. They still have to pay their bills, their energy, they still have to go to the doctors, and those things do well regardless of the economic conditions because people continue to need them. So people tend to shift from those high growth things during the bull market and put their capital into those more defensive stocks, which tend to do well regardless of the economic situation one is faced with. Now, recognizing these patterns is, if you do technical analysis, you're going to use this a lot, whether that's head and shoulders, double bottom, tops and bottoms. You can use technical analysis to predict the future movements. This is because these patterns have repeated over time, and they're based off, price movements and trading. And these patterns are caused by human psychology. Once you start to recognize the patterns, then you can make predictions based off that. And then, you can exploit human psychology. You know that when it gets to here, humans tend to sell, so you can preempt what's going on, and when you do that, you can make massive returns using technical analysis. But another pattern which we've seen recently is with interest rates. So obviously, in 2008, they reduced the interest rate basically to zero. We had a zero interest rate environment. And what this means, if you follow the pattern, is lower interest rates lead to lower borrowing costs for companies, which means they can increase their profits, their margins, their earnings, which obviously makes businesses and stocks more attractive to investors. It also reduces the attractiveness of things like bonds. Say if your interest is 1%, if you're only getting 1% on a government bond, you might as well put it in the stock market where you can get, a 10% return investing in the S&P 500. It's almost silly to invest in bonds when they're at such a low rate. But so people, reallocate more into the stock market compared to the bond market, which further, drives up the prices, which fuels these companies, and overall leads to, higher growth, or is meant to lead to higher growth because you have this reduction in borrowing, more liquidity, more people, more buying pressure into the stock market, and they can fund innovative programs, research, and for a lot less because the borrowing costs are so low. But conversely, as we've seen when the interest rates go up, as we've seen over the sort of the past 12 to 18 months, borrowing becomes more expensive and bonds become much more attractive. If you can guarantee yourself 5-6% return from government bonds, then that's a very sensible investment. Like, why would you risk anything else when you can guarantee yourself 5%? And that puts selling pressure on the stock market, and is why the short, if you look at the short rated bonds, they've seen a dramatic rise because everyone's pouring the money into short dated bonds because the interest rates are so high, and why the stock market has crashed because people allocated their capital from stocks and putting them into bonds, and that is the effect of the pattern of interest rates. Another pattern to consider is and to study is the pattern of inflation. So inflation, we've also seen inflationary cycle recently, where sort of the purchasing power of your currency declines, and normally during periods of high inflation, you have high interest rates to try and slow down the economy and cool the economy off. And we've sort of gone on to the secondary impacts of that. From high interest rates, you get high inflation, you get high interest rates. And I, just covered the impact of interest rates on the stock market. And that's something you've seen. So if you saw that inflation was coming, you'd be able to make the prediction that stocks would fall. And, you could prepare yourself either by shorting the stock market or by moving money into bonds. And you can only do that once you understand that these patterns occur time and time and time again. So whilst history doesn't repeat itself exactly, it certainly does rhyme, as the saying goes. And yeah, the lessons of history are definitely worth, and the patterns are worth learning, because they can guide you and help you navigate the future landscape. As I said, really recommend you use this book, read this book. If not this book, go ahead and watch his video. That's going to really help you understand the patterns, help you begin to recognize these patterns. And then once you do that, you're going to be able to start to predict what's going to occur in the future. And that is really going to be to your benefit. I hope you've enjoyed this video. Please like, subscribe, and thank you.